Our next guest says that he sees more room for the markets to rally from here. Joining us right now is Stephen Parker. He's the head of specialized strategies at JPMorgan Private Bank. And Stephen, I think you're getting at the issue that people are wondering everywhere right now. If you haven't been invested, the market's at new highs after this kind of crazy start to 2024. People are wondering if they missed out. You're saying it's not too late.
No, I don't think it's too late. You know, last year markets certainly were climbing the wall of worry. Nobody wanted to believe in one of the strongest rallies that we've seen in a long time. And now you get headlines about new all-time highs, and that gives people a reason to think that maybe it's time to sell. The reality is, if you look back historically, buying at all-time highs has actually been a very good strategy. A year later, you're typically up 70% of the time, close to 10% returns. So I think the focus should be less around the headlines and all-time highs and more around the fundamentals. And we think that the earnings story is compelling. We think that the policy story is going to offer tailwinds. And we think that the corporate sector is in really good shape.
What's the counter case for this? I think a lot of people want to believe this. There's a ton of money on the sidelines, and there's probably a pretty good argument for it. But if you had to make the counter case, if you had to argue on the other side, what would you say?
I think the counter case is that, one, markets seem to be coalescing around this view that inflation is softening, which allows the Fed to ease because of that inflation story, not because the growth story is really bad. I think if we were to have some sort of shock and see a downside surprise to economic growth that forced the Fed's hand because of a slowdown rather than inflation cooling, that's potentially a big risk to the market. But that's not our base case. It's not showing up in any of the data we're seeing.
Let's say the Fed decides not to cut rates, but they do what Steve was just discussing, and they stop quantitative tightening. Is that in itself enough liquidity or extra boost to the market to keep things going?
I think that probably causes a sell-off in the short term. I think markets are coalescing around this idea that the Fed is going to be cutting rates this year. And while the end of QT would be an easing method for financial markets, I don't think it would be enough. The good news is the expectations around what the Fed is going to do have come down a little bit. If you went back
but if it's not enough, if the economy is chugging along, things are good, and the Fed takes its foot off of the brake that is quantitative tightening.
I think the reason why markets would take that negatively is because they would view that as a sign that the Fed is a lot more worried about inflation being sticky or turning up again. If they weren't willing to cut rates, particularly given what markets have priced in at this point, I think that would be the big fear that would be expressed and caused a pullback. But frankly, one would be looking to buy.
That may not be your base case, but that doesn't seem like a crazy scenario.
I think what you would hear from the Fed has learned their lesson over the last decade or so. They're going to communicate. They're going to over-communicate. They're not looking to surprise the market. So going to where we are today, which is markets pricing in 100 to 125 basis points worth of cuts this year, to not cutting at all, I would view that as a big shock. And markets
Is the market listening, though? Because it seemed that when the market made those assumptions, the Fed sent everybody out to kind of talk back those expectations.
Yeah, but if you look at what's being priced in, I think there's a little bit of a balancing act. And I think maybe the 125 basis points in cuts, markets may be a little bit more sanguine in terms of how much we'll see. But I think the direction of cuts is certainly being priced in, and that would be a shock, particularly in terms of the communication side of things that I think would rile markets a little bit.
All right, so where do you like best? What sectors within the market?
So there's a couple areas that we really like. We do think, despite the strength last year, there's a lot of opportunities in tech. There's a lot of focus on the Magnificent Seven. But when you think about those companies, they look expensive relative to their history, but not so much relative to the growth rates that they're delivering. Tech also has little to no debt, so there's not an issue around what's happened with higher rates. And tech went through an earnings recession last year. So we think that the growth outlook for the tech sector looks really good. Early reports are positive on that end. We also think that the rally widens out. Small and mid-cap names, particularly more quality parts of the small and mid-cap area, which actually started to outperform in the back half of the last year. We think there's still a catch-up trade there.